Most of us have a drawer at home filled with stuff. Rubber bands, koozies, batteries, birthday candles, maybe a screwdriver. Each item has a purpose, but thrown together, it's not a system. It's a junk drawer. A lot of retirement portfolios look the same. Multiple accounts, lots of funds, few old 401ks, maybe some dividend stocks. Each piece may have merit on its own, but without coordination or intention, it becomes a collection, not a strategy. Today in the Retirement Pathfinder series, we're breaking down the illusion of diversification and why having a bunch of stuff is not the same as having a plan. One of the most common assumptions we hear from retirees is this: we've got accounts spread out, different funds, so we must be diversified. But when we run a true overlap analysis, many of those investments are simply duplicates. Different wrappers, same holdings, same exposure, same behavior in a downturn. That's not diversification, that's concentration disguised as complexity. In retirement, that false sense of security can create real problems. Capital markets are built to help people accumulate wealth. There's a built-in tailwind, compound growth. When you're working, you can dollar cost average. You're contributing often. You have time and flexibility. But retirement flips the script. Now the portfolio has to pay you. It's not just about growth. It's about stability, income, and how those distributions interact with market volatility, taxes, and inflation. Decumulation is a different problem, and it needs a different structure. True diversification in retirement isn't about how many funds you own. It's about how your portfolio behaves under stress. It's about how well your income strategy functions when markets don't cooperate. A properly diversified retirement plan includes growth positions for long-term inflation protection, income-producing assets for short and mid-term needs, buckets that are low correlation to equity markets, cash and near cash for flexibility, and tax-smart withdrawal planning to limit drag. Every investment should have a defined role. Every dollar should be doing a job. We've worked with many investors who did a great job managing things on their own during the accumulation years. When markets were rising, the results looked great on paper. But often when benchmarking performance against appropriate risk-based indexes, gaps started to appear. Portfolios earning 8% should have been closer to 10% given the level of risk assumed. And that 2% difference wasn't the market. It was structure. It was inefficiency. Even worse, the decision-making process was emotional. It's going up, let's not change anything. It's going down, maybe it's time to make a shift. Or my favorite, I'll just ignore it completely. Confidence in bull markets, anxiety in bear markets, or indifference overall. That's not a plan, that's just reacting. If your retirement portfolio looks more like a junk drawer than a well-built system, it may be time to reassess. Diversification in retirement is not about spreading your money across platforms or products. It's about designing a strategy that can fund your life with resilience, flexibility, and clarity, regardless of what the market's doing. We help people navigate this transition every day. If you're unsure whether your current portfolio is truly built for the decumulation phase, we'd be happy to take a look. Thanks for watching the Retirement Pathfinder series.